Joining us right now to talk stocks, SkyBridge Capital Senior Portfolio Manager Troy Gayeski. Troy, it's good to see you.
Yeah, great to see you,
Would you buy into this market right here? Yeah,
we think ultimately at the end of the year, stocks will be higher than they are today and higher than they started. And I think you guys hit on a lot of key points, right? Since Trump was elected, the good Trump has been about tax reform and regulatory relief, and the bad Trump's been about protectionism and tariffs and other, let's say, non-market friendly policies like intervening in AT&T Time Warner, for instance. And so what we saw was a clearly concern over tariffs, what impact that would have on GDP. But what investors haven't focused at all about is that perhaps there is a positive outcome here where ultimately this is a negotiating ploy to gain more access to Chinese markets for American companies. So no one's even discussed that broadly, that you can increase earnings or revenue getting better access to Chinese markets. So no one's saying that's going to be the outcome, but if we can avoid a full-blown trade war, it makes a lot of sense that markets bounce back yesterday.
I mean, everybody gets that when you're in business, particularly in financial services, that there are industries in China that are just no-go.
Oh,
you're not even allowed, the government there won't even allow you to own a 49% stake.
That's right.
Never mind an ownership stake. So I wonder if that will, in fact, we'll see a loosening up of that.
Let's not get carried away.
Right.
But the question is, how much damage will tariffs and protectionism ultimately do, right?
Yeah.
And, you know, time and time again, markets prognosticators always assume that the Trump administration's opening line is the end game, when in fact it's the start of a negotiation.
Yeah. So, Troy, I'm curious, though. I mean, short term, we're seeing the markets bounce back as China's trade war issues ease. But in the long term, how does this affect the trust of the Chinese as they kind of build up their own advanced manufacturing, advanced technology, and become less reliant on the U.S.? I mean, for even the short-term access to China, how does that compromise our mid to long-term trade opportunities?
Well, that's what they're doing. You're right. You're building up industries to compete with America, 100%.
Yeah, I'm sorry, I don't actually understand the question in terms of their industrial productive capacity?
So a lot of the issue right now is even things like how much will China spend buying U.S. chips, while at the same time they're increasing their manufacturing capacity for chips domestically.
Correct.
And so I guess what I'm saying is, if we continue to have these types of trade wars, even if it's a negotiation tactic in the short term, how is this going to affect our mid to long-term trade situation with China as they need us less?
Well, look, let's not be delusional. Mercantilism is not going away in China anytime soon. The point of what I was saying is that when you start out with a market assumption that any discussion of tariffs is going to be an extremely negative outcome, and that gets peeled back to, hey, it might be less negative, and hey, if we could get more access to Chinese markets, it could be a slight positive. That partially explains fundamentally why markets rallied back yesterday. In terms of medium to long term, look, we're the two largest economies in the world. We have to figure out how we can coexist equally. But from a political standpoint in the U.S., it's critically important that the red part of the country does not continue to feel like they're getting the shaft by trade agreements, which has basically been the fault of both political parties for 30 years.
Let's talk about the red part of the country, because I was reading the Federal Reserve's Dow's Manufacturing Index, and it did fall month over month and came up short of expectations yesterday. But if you read in the commentary, because I'm a loser, and that's what I do, but you read the comments from some of these businesses, the primary metal manufacturing, the steel tariff got hurt. The steel tariffs are a real concern from petroleum and coal products. Fabricated metal product manufacturing, the recent steel tariffs could severely impact our business. They're worried about when they go away, when they show up, are they going to have trouble sourcing, or their own, what they pay for steel and aluminum, is it going to go up? Again, that's the kind of uncertainty you want to try to avoid fomenting.
Look, it's at a much smaller scale, but it's a similar disruption to what Obamacare injected on the economy, right? When you ask economists about the impact of Obamacare, it's hard for them to give you a number, but they don't focus on the disruption and the freezing of business activity. The same can be argued for tariffs. However, even if you look at the steel tariffs, you started out with a more sweeping, inclusion of countries, and now that's already been walked back.
But that's my point, is that you would make this announcement to all these businesses in the United States that use steel as a consumer of it, and they're sitting around going, what's going to happen?
Yeah, look,
to prices, to buy supplies.
Economically, no one can argue that protectionism is a net benefit to the global growth. However, remember the big picture political landscape here, where voters basically said, we've looked at the trade agreements we've had for 20, 30 years. Globalization's benefited the elite, but it hasn't really benefited the average worker whose wages have stagnated. So the status quo can't hold. We might all disagree with the techniques used or the aggressive posturing, But
Yeah.
at the end of the day, you need some movement to satisfy the American electorate, both on the
that's
left
what we
and
say.
the
This
right.
is the beginning. But look, we want to get your expertise on markets. Okay, we got earnings starting in about 2 weeks. We got the banks reporting their first quarter in the first next couple of weeks, and then you've got obviously just a week out of the Federal Reserve. How are you allocating money right now?
Yeah, so we're really focused on regional community banks. We talked about this before, where you have an improving credit quality at regional community banks due to a stronger economy. On top of that, you have Fed rate increases, which help net interest margin in some cases, particularly those with low deposit rates. You have a massive tailwind of regulatory relief, which is the way the administration interprets existing law. And now you finally have bipartisan legislative changes, which are one of the only things in D.C. that you can get bipartisan consensus on. So that's an area where we don't need things to improve from here to have a decent return. But if we get the legislative reforms, you have even more upside, and that looks very promising.
And the quarter ends this week. Do you expect any sort of end-of-quarter positioning in markets that you want to talk about in terms of how this market trades?
Well, look, the one conclusion we've all discussed is volatility is going to be higher this year. It looks like we're in for a strong close to this month. We don't think investors should chase the rally, but we think they should think about allocating the alternatives to decrease risk, particularly to the bond part of their portfolio.
Troy, I have one quick question.
Sure.
Facebook's gotten hit pretty hard in the last 24 hours,
Has
obviously.
it? No. Yeah.
Last week.
Yeah, I mean, I'm curious. I mean,
10% last week.
It's huge. I mean, a lot of the focus has been on Cambridge Analytica, which is just one of thousands of companies that have been harvesting data from Facebook and others. So I'm curious, what other tech companies do you see getting hit as these regulatory frameworks start to move forward?
And let's not forget the Federal Trade Commission is probing Facebook, the data practices, the company is reeling from this scandal. And we've been talking about this for a long time on this program, certainly, that the regulatory environment is about to get hotter.
100%. And it's for the whole swath. So right now, so far, Amazon's been fairly resilient. However, if you look at some of their, some of the issues on taxing their sales at the state level and others, that's an area that's one company that could get hit as you get more regulatory pushback. You also have Google or Alphabet that could get pushed back. And the broader point here is tech has outperformed so dramatically, right? For good reason, but the momentum has been so high. You've finally seen that break. So for investors,
this data issue is that break that could
so we've talked about and Facebook's right in the crosshairs, right, from a political standpoint, but they're not the only one. And so the way markets work is fundamentals improve, people buy. Then they buy more. Before you know it, you have tons of momentum and something's overowned. Then you get a sea change in the thesis, which the only thing we could think of was political risk. You're starting to see that, and that finally causes investors to take a pause and sell. So we just advise investors to think about lightening up on tech. It's had a great run.
Have you been lightening up on tech?
We've been light on tech for quite some time. Okay. So to be fair, we don't have a dog in the fight in terms of reducing exposure because we're not a high beta shop. But if you have made good profits, it's not a bad time to take some of those profits, rotate into things that have lagged, like financials.